you can legally buy a bank. Right now, this week, with less money than a McDonald's franchise. But here's the strange part. The people who own banks are not the richest people in banking. And the business that prints money, literally creates money out of nothing every single day, is also one of the most reliably destroyed businesses in American history. By the end of this video, you'll know exactly how that's possible, how banks actually make money on the inside, why a business with a legally guaranteed profit mechanism keeps producing the most spectacular bankruptcies on Earth, and what it actually costs to own one. Banks come in three sizes, and they are three completely different businesses. A small community bank in a mid-sized American town costs somewhere between $12 and $20 million to start from scratch. That gets you a charter, a building, a handful of tellers, and a loan officer named Gary who knows everyone in the county. You'll serve maybe a few thousand customers. Your biggest loan will probably be to a local construction company. And your most exciting day of the year will be the 4th of July float you sponsor. Not glamorous. We'll come back to how much money Gary's bank actually makes. A regional bank, something with 20 to 50 branches across a few states, costs anywhere from $500 million to a couple of billion. Think the kind of bank that sponsors the local sports arena and has a drive-through at every Walmart. These institutions hold tens of billions in deposits, and their CEOs make appearances on CNBC during slow news cycles. And then there's the top. JP Morgan Chase has a market cap of over $600 billion. Bank of America sits around $300 billion. You are not buying those. But the interesting part, the part that breaks people's brains, is that the cheapest entry point in this industry is almost absurdly accessible. The FDIC has approved de novo bank charters, that's a brand new bank from nothing, for as little as $10 to $12 million in capital in certain states. For context, a single Chick-fil-A franchise costs $10,000 to enter and still requires $250,000 in liquid assets. You could, theoretically, own a federally insured bank for the cost of a nice apartment building in Austin, but the charter is just permission to play. The question that actually matters is, once you have the keys, how does the thing make money? Here's how banking works, and I mean really works in a way most people never get taught. Imagine you hand me $1,000 to hold for you. I put it in a drawer. That's what most people think a bank does. But that's not what happens. What actually happens is, I take your $1,000 and I lend $900 of it to someone else at interest. I keep $100 in the drawer in case you want some back. You still think you have $1,000. The borrower thinks he has $900. There is now $1,300 of perceived money in the world. I created $900 out of nothing, and I'm charging interest on it. That's fractional reserve banking, and it is completely legal. It is, in fact, the foundation of the entire global economy. Now, here's where it gets surgical. Say I'm lending at 7% interest and paying you 0.5% on your savings account. That gap, 6.5 percentage points on every dollar I lend out, is called the net interest margin. It's the coin flip of the banking world. Every dollar that comes in the front door as a deposit gets transformed. I pay you a little to hold it. I charge someone else a lot to use it. The spread is my profit, and it runs on every single dollar, every single day, automatically. In 2023, the average net interest margin for US commercial banks was around 3.3%. Sounds small, but multiply 3.3% against $23 trillion in outstanding bank loans across the American banking system. That is the machine. A quiet, invisible, automated engine that runs regardless of whether anyone in the building is paying attention. And here's the part that breaks people's brains. The bank doesn't need the money to exist before it makes the loan. Under fractional reserve rules, for every dollar held in reserve, a bank can lend out roughly 9 or 10 more. A bank with $1 billion deposits can generate $9 billion in loans. The interest income on those $9 billion flows back to an institution that, in a meaningful sense, conjured the principle from thin air. Every other business on earth has to acquire something before they can sell it. Banks manufacture the inventory as they sell it, so that's the mechanism. Now let's talk about the architecture, the systems layered on top to make sure the money never stops. First, there's the fee economy. A bank's net interest margin is the core, but fees are the muscle. Overdraft fees alone generated $7.7 billion across US banks in 2022. ATM fees, wire transfer fees, monthly maintenance fees on accounts that never get used, late payment fees, foreign transaction fees. The average American pays $329 a year in bank fees without noticing. These fees don't require the bank to take any risk. They're pure extraction. And the targeting is precise. The customers least likely to monitor their balance are the ones most likely to trigger an overdraft. The customers who need to wire money internationally are the ones with the fewest alternatives. The fee architecture isn't random, it's engineered. Second, there's the float. When you deposit a check, the bank often makes that money available to you in 1 to 2 business days. But the actual settlement, the movement of real funds, can take up to 5 days. In between, the bank is earning interest on money it has already credited to you. Multiply that by millions of transactions a day, and you have a passive income stream that generates hundreds of millions of dollars annually across large institutions and requires no staff, no decisions, and no risk. Third, and this is the one that should haunt you, there are the credit cards. Banks don't just lend mortgage money and business loans. They run credit card portfolios that carry average interest rates of 20 to 24%. The average American household carries $6,000 in credit card debt. At 22% interest, that's $1,320 a year in interest payments on a balance that almost never gets paid off in full. The customer feels like they're managing their debt. The bank is watching a perpetual motion machine, and at the very top of this pyramid sit the commercial relationships. Big corporate lines of credit, acquisition financing, treasury management services for Fortune 500 companies. One relationship with the right company can generate more fee income in a year than 1,000 retail customers combined. The big banks don't need you. They keep your checking account because it's cheap capital, and your direct deposit is a useful data point. You are not their customer. You are their raw material. So with all this guaranteed math, this fractional multiplication, this fee architecture, these perpetual motion credit balances, why do banks collapse? Same reason casinos do. Not because the machine broke, because someone built the wrong thing on top of it, and 2 failure patterns keep showing up over and over again. Failure pattern 1. Too much concentration. In 2023, Silicon Valley Bank held $209 billion in assets and was considered one of the most sophisticated financial institutions in the country. They made one structural mistake. Nearly all of their deposits came from tech startups and venture capital firms, and nearly all of their assets were locked into long-duration US Treasury bonds purchased when interest rates were near zero. When the Fed raised rates aggressively, those bonds lost value on paper. When word got out, their depositor base, an unusually tight, Twitter-connected community of founders and VCs, organized a bank run in less than 48 hours. $42 billion in withdrawal requests in a single day. The bank failed on March 10, 2023. The FDIC had to step in over a weekend. $209 billion in assets, gone in 48 hours. Not because their loans went bad, because every single one of their customers knew each other and panicked simultaneously. Failure pattern 2. Loans that should never have been made. Washington Mutual was the largest savings and loan in American history. At its peak, it held $307 billion in assets. Between 2004 and 2007, it aggressively expanded into subprime mortgage lending, handing out home loans to borrowers who had no income documentation, no down payment, and in some cases, no pulse that could be verified by normal banking standards. When housing prices stopped rising and borrowers started defaulting, the loan portfolio collapsed from the inside. In September 2008, WaMu was seized by federal regulators in the largest bank failure in U.S. history. $307 billion in assets wiped out, not by a recession alone, by a deliberate decision to take risks the math couldn't cover. If you're going to build a business that manufactures money, make sure the people you're handing that money to can give it back. Step back for a second. The economics of this industry are genuinely paradoxical. A bank has one of the most durable revenue mechanisms ever invented by human civilization. The net interest margin runs every day. The fee engine runs every day. Fractional reserve multiplication means the bank profits on money it created. No other legal business does this. A restaurant has to buy the food before it can sell the meal. A bank loans money it doesn't technically have and charges interest on it for 30 years. And yet, American banks fail at a rate that would embarrass most industries. Since 2000, over 500 US banks have been seized or closed by regulators. In 2010 alone, 157 banks failed in a single calendar year. The FDIC's list of problem institutions, banks with serious regulatory concerns, regularly runs into the hundreds. Why? Because the machine only works if trust holds. A bank is not really a financial institution. It's a confidence institution. The moment customers believe their money is in danger, the machine that creates money out of thin air becomes a machine that destroys it just as fast. The math is bulletproof. The human behavior around it isn't. Pull it all together. How much money do you actually make if you do this right? 2 scenarios, real numbers. Scenario 1, a community bank. You raise $15 million, get your charter, and open in a suburban market. Year 1 is rough. By year 3, you're holding $120 million in deposits and have $95 million in loans on the books at an average rate of 6.5%. Your cost of funds, what you're paying depositors, is around 1.5%. Net interest margin, 5%. Net interest income, about $475 million. After operating costs, salaries, compliance, software, you clear around $1.2 million in net profit. Payback, 12 to 13 years. Not exciting. But you own a federally insured institution with a government-mandated moat. Nobody can legally compete with you without jumping through the same regulatory hoops it took you 2 years to clear. And every year, the deposit base grows and the margin compounds. Scenario 2. A regional bank built over 20 years, $8 billion in assets, $6 billion in loans, net interest margin of 3.5%. Net interest income, $210 million a year. Fee income, another $40 million. Total revenue north of $250 million. After expenses and provisions, net profit around $80 to $100 million a year. And the multiple investors will pay to acquire a well-run community bank, typically 1.5 to 2 times book value. Your $15 million becomes a $200 million institution that someone will pay $300 million to $400 million to acquire. The math, if you survive it, is extraordinary. And if you survive long enough, you become something specific. Andrew Beal started Beal Bank in Dallas in 1988 with $3 million of his own money. He didn't build branches. He didn't chase retail depositors. He bought distressed loans nobody else wanted at pennies on the dollar then waited for borrowers to restructure or for collateral to recover value. He was almost the only buyer in certain markets during the savings and loan crisis of the early 1990s, the dot-com collapse, and the 2008 financial crisis. Every time the system broke, Beal was the one with cash. Today, Beal Bank holds over $30 billion in assets. Andrew Beal's net worth is estimated at $13 billion. He never went public. He never raised outside capital. He just understood that in banking, the real money isn't made when times are good. It's made by being the only person in the room when everyone else is panicking. So, if you decide to buy a bank, just remember the most important rule of this business. The machine always runs. Just make sure you're the one who built it.